It looks like stocks are mixed here as we head into the close of the trading day. The Dow giving up its earlier gains, triggered by news that Apple will be closing some of its U.S. stores. We have the Dow off just over 160 points. S&P also in negative territory, off just around 0.4%. The Nasdaq, the only one of the major averages, holding on to gains, up just around 0.1%. And that wraps up this week's trading week, a pretty volatile one at that, with the Dow and the S&P closing in negative territory. And it looks like the Nasdaq is going to hold on to gains. For the Dow off just over 180 points. Raytheon Technologies, Disney, Boeing, and Nike are the worst performers in the Dow today. All four of those stocks off more than 2%. We're also seeing weakness in the S&P, off just around 0.5%. The Nasdaq, the only major average, like I said before, in the green. It's its sixth straight trading day of gains here. So the rotation here back into some of those big tech names. Some of the losers, though, in the market today, coming on the heels of that report that we got from Apple saying that it will close some of its stores in the U.S. as stocks benefiting from the economy reopening are in the red on that announcement. Some of the retail names, Gap, Macy's, Kohl's, and Nordstrom, all trading to the downside. Travel is also a loser today, with United, Delta, and American all moving to the downside. And a lot of those cruise lines are also in the red. We have weakness here in Norwegian, in Royal Caribbean, and also in Carnival. Sector-wise, 9 of the 11 sectors moving to the downside today. The only 2 sectors in the green are healthcare and materials. I want to bring in my co-host, Miles Udland, here for the show, and along with Rick Newman and Akiko Fujita. And Miles, I guess when we take a look at today's action, this leg lower heading into the close, what sticks out to you?
Well, I think this week has been an interesting one in that, last week we saw that 5% decline on Thursday, a real reminder that we still remain in a very volatile regime with respect to what the market might do on any one given session. But I thought this week was kind of a reminder to investors that the pandemic has not actually ended. And I know there's been some excitement about that, given what we saw with the May jobs report and some economic data turning a bit higher. But this week, the main market stories, and we had U.S.-China trade come up a couple of times, and that's a very interesting dynamic as well, that 3 years into U.S.-China trade headlines, we're still moving the market on that. But ultimately, it was case counts in Arizona, California, Texas, Florida. These were the incremental bids, the incremental drivers of market sentiment. And we haven't seen the virus serve as that incremental, kind of push towards onto the market one way or another, really since, in my view, kind of early mid-April, when we really started to see things begin to peak. And, here in New York, we heard Governor Cuomo talk about the other side of the mountain. He's been discussing that for some time. Well, by April, right around Easter, that is when things were at the absolute height. And the slow improvement in COVID data started to see the market get a little more positive on the medical side. But that's now 2 months in the rear view. And I think investors maybe forgot that we are, again, still in the midst of a pandemic that is mostly spreading kind of uncontrolled here in many states. And there was definitely a sense that it had somehow been fixed because we had a couple of good points of economic data and stocks went up. But this week, in my view, a reminder of what the real driver is here when it comes to everything we've gone through in the last 3 or 4 months.
The pandemic certainly is the big driver, and I agree with you. Investors are taking notice of this once again as we do see the number of cases rise in some states.